Do you know what your credit score means for your financial future? It's a number that represents so much more than just a digit. It's the key to unlocking a world of opportunities. Let's break it down. A credit score is an essential part of your financial profile. It's like a report card for your finances, reflecting how well you handle your money, particularly with regards to borrowing and repaying debt. It's used by lenders, landlords, and even some employers to assess your financial behavior. Think of it as a gatekeeper. A good credit score can open doors to prime interest rates, making big purchases like homes or cars more affordable. It can also make you a more attractive rental candidate and even improve your odds of landing your dream job. On the flip side, a poor credit score can limit your options, making it harder to secure loans or negotiate favorable interest rates. Understanding your credit score is the first step to financial success. Let's unpack this further in the next segment. But what exactly is a credit score and how is it calculated, you may ask? Well, let's break it down. A credit score is a numerical summary of your credit health, and it's determined by 5 key components. First on the list is your payment history. This is the record of whether you've paid your bills on time, and it's the most significant factor, accounting for about 35% of your score. Consistently paying your bills on time shows lenders that you're reliable, which can positively impact your score. Next up, we have your credit utilization rate, which is how much of your available credit you're using. This makes up about 30% of your score. If you're using a high percentage of your available credit, it could signal to lenders that you're overextended and may not make payments on time. The length of your credit history accounts for about 15% of your score. This is simply how long you've had credit. Generally, a longer credit history will increase your score. The types of credit you have make up 10% of your score. This includes credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. Having a mix of credit types can improve your score. Finally, recent credit applications account for the last 10%. Applying for new credit can cause a small temporary dip in your score. Your credit score is more than just a number. It's a reflection of your financial habits. So, understanding these components can help you take control of your credit score and, by extension, your financial future. So what happens if your credit score is less than stellar? Well, the ramifications can be quite extensive. A low credit score can make it harder to secure loans or credit cards. And when you do get approved, you might find yourself saddled with higher interest rates. These higher rates mean you'll pay more over the life of the loan, making it more difficult to achieve financial freedom. But it's not just about loans and credit cards. A low credit score can also impact your ability to rent an apartment. Landlords often check credit scores to determine if you're likely to pay rent on time. Similarly, certain jobs, especially those in finance, may require a credit check as part of the hiring process. A low credit score can feel like a weight around your neck, affecting many areas of your life. But remember, a low credit score can close doors to opportunities, but it's not irreversible. Let's explore how to boost that score in the next scene. Now, how can you improve your credit score? Well, let's dive into some practical tips. First and foremost, ensure you're making your payments on time. This is crucial because your payment history contributes significantly to your credit score. Late payments can have a negative impact, so set reminders, automate your payments, do whatever it takes to pay those bills on time. Next, keeping your credit balances low is another effective strategy. This means not maxing out your credit cards and maintaining a low credit utilization ratio, which is the percentage of your available credit that you're using. A lower ratio is better for your score, so aim to use less than 30% of your available credit. Also, it might seem counterintuitive, but don't rush to close old credit cards, even if you're not using them. The length of your credit history can affect your score, and older accounts can actually help. Finally, be mindful of new credit applications. Each time you apply for credit, it can cause a small dip in your credit score. So, apply for new credit only when necessary. And remember, at Genesis Financial Recovery, we're here to assist you. Our experts can provide personalized strategies to repair and boost your credit, helping you navigate the complexities of the credit world. With discipline, patience, and the right guidance, you can raise your credit score and open new doors for your financial future.